Assalamu alaikum wa rahmatullah. Hello and welcome to our YouTube channel Business Mindset with Amin. Throughout this video, inshallah, we are diving into a key topic for anyone interested in finance or business management, which is the financial statement. So, stick around, subscribe if you haven't already, and get ready to learn the basics that will help you to take control of the financial situation of the company. So, let's get started. At the end of each financial year, companies are typically required to prepare several financial statements to provide a comprehensive overview of the financial performance and position. These statements include the balance sheet, the income statement, the cash flow statement, and the shareholders' equity statement and note to the financial statement. As you know, these financial statements are provided by the company, but in fact, these financial statements are used by internal and external users. So, we have to know what are these internal and external users that can analyze this financial statement and what is the purpose of each user. So, as an external users, we can find the creditors or banks. So, banks and creditors can use or has the ability to analyze the financial statement. So, creditor and banks in general has the ability to analyze this financial statement because it is so important for these creditors to analyze this financial statement of the company, because they can see whether this company can afford to pay back the debt and to know if the company has the enough solvency. After that, we have to know what does mean the solvency. We can find also investors. The information provided through the financial statement is very vital for the investors to make their decision, which means the decision that is related to investment, to invest within the company or not. We can find also the government. So the government uses the financial statement for the purpose for taxations, regulations, policies on the way the company is running its operation. Manager, as internal users, have the ability to analyze the financial statement, but here this analyze is for the purpose to take out the strengths and weaknesses of the financial situation of the company. The shareholders analyze the financial statement because this financial statement give a clear picture of a company's financial health. So the shareholders, who are the owner of the company, have to know if the company still provides profits and has the potential to grow. So, as we mentioned before in our introduction, that the company has to establish 5 financial statements. So now we start with the first financial statement, which is the balance sheet. So, how can we define this financial statement, the balance sheet? So, the balance sheet refers to financial statement that reports a company's assets and liabilities and shareholders' equity at specific point in time. Furthermore, balance sheet is a financial statement that provides a snapshot of what the company owns and owes, as well as the amount invested by the shareholders. So after knowing that the balance sheet is to determine what are the assets of the company and what are the liabilities. So let's give you a definition or simple definition of assets. So what does mean assets? So assets, it is a resource with economic value that the company owns or controls with the expectation that it will provide a future benefit, or something of value that the company owns or that owed to another company. For example here, if a company lends the money to another company, that loan is also an asset because the company due that amount. However, the liability, it refers to things such as money or so on that the company owe or have borrowed. The shareholders' equity is the third part of the balance sheet. It refers to the net worth of the company because it represents the amount of money that would remain if a company were to be liquidated and all of its assets sold. Thus, it's equal to total assets of a company minus its total liabilities. So, within the balance sheet, the assets should always equal to the liabilities of the company and the shareholders' equity. This means that the balance sheet should always be in balance. However, if there is no balance within this financial statement report, there may be some issues including incorrect or misplaced data, eventually errors, or miscalculation. So here you have to know that assets is always equal to liabilities plus shareholders' equity. So within asset section, we can divide it into two major parts. We have the fixed assets and the current assets. The fixed asset we can name it as no current assets. So the fixed assets or no current assets are resources with expected life of greater than 1 year. We can find three major parts within these fixed assets. We can find the tangible assets, intangible assets, and the financial assets. Tangible assets are assets that are physical in nature and have a long-term presence in the operation of a company. Intangible assets are economic resources that have no physical presence. It's not like tangible assets, but they include copyright, trademarks, goodwill, and so on. However, the financial assets are the long-term financial instruments such as stocks and bonds and other types of securities. They are valued according to their current price on the relevant market. In the second part in assets, we can find how we call the current assets. The current assets are short-term economic resources that are expected to be converted into cash or consumed within 1 year. Now let's move to the other section of balance sheets. It's the liabilities. In the liabilities, we can find two major parts: no current liabilities and current liabilities. No current liabilities are the debts that company owes, but is not to pay for at least 12 months. However, the current liabilities, they are the debts or obligations that are due to pay to the creditors within just 1 year or less than 1 year. The third concept within the balance sheet is how we call it the shareholders' equity. So, what does mean the shareholders' equity here? The shareholders' equity is the difference between assets and the liabilities, and it represents what? Here, it represents the remaining value if all assets were liquidated and all liabilities were paid off. So, thank you for watching this video, and don't hesitate to subscribe in our YouTube channel. So I see you in the next lesson with a new video and new lesson chart.